And happy Monday, Market Rebels, and to all of our people watching on YouTube, live streaming, and on Twitter. It's great having you here. Today is Monday, July 11th, and as I was checking going into the close, it looked like I was hoping we were going to get 7 straight green candles, but didn't get it today. But more volatility, which is really the theme and some of the things that we're trying to talk about, at least for the foreseeable future. Give you some tips and trading tips, ideas, trading tune-ups, help you make better decisions. Now, of course, we have earnings season coming up, so that's always going to add to the interest and the volatility. So what I thought would be something good to do this week, a little different from what I've done, we're going to do a little trilogy. We're going to do a pricing principle today on Monday. We'll do another one on Thursday. And then we're going to put them together on Friday. And I'm going to show you how when you understand some key pricing principles, they are absolutely essential for making decisions, not only on strategies, but your hedges, rolls, and morphs. I'm a huge believer in pricing principles because, again, they just make things easy. So for today, we're going to talk about our very first pricing principle. Where did we go here? There we go. Pricing principle number 1, and it is just, we might call it a call and put strike relationships. So in option pricing theory, there's what we call boundary spaces. There are absolute minimums, there are absolute maximums, and then of course, if you want to dial in, this is where you have to get into a pricing model. But if you can at least understand the boundaries, it goes a long ways into making you better traders and helping you make better decisions. So before we get started, I wanted to do some questions, throw out a little quiz. We'll answer them at the end. But for example, let's say that you buy a March 85 call and sell a January 70 call. Is that bullish or bearish? Quick. You should be able to answer that immediately if you know your pricing principles. What if you buy the July 200 put, sell the July 210? Is that bullish or bearish? You should have the answer already. And if you don't, this is going to show you why they're so valuable. Here's another one. What if you buy the January 100 call and buy the January 105 put for $9, a strategy called a strangle? What's your maximum loss? Now, most people would say, oh, I know that. The most you can lose is the amount you paid. Therefore, it's $9 or $900 total. Very obvious, but also very wrong. And we'll find out why at the end. So, pricing principle number 1. What this says is that lower strike calls and higher strike puts must be worth more money. Okay, not they should be or that we kind of think they might, they must be. Now this of course assumes that we're talking about the same time to expiration and the same underlying. So for instance, if we have the July 100 call and the July 105, I don't even need to know what the stock is. I don't need to know how many days are till expiration. I don't need the volatility. I don't need anything. I've got all the information that I need right there. I can tell you for sure the July $100 call will be trading for a higher price. How much higher, I can't really say until we come up to Thursday's class. I just know for right now that it's got to be higher. Now, one way to understand this is that it gives you the right to pay less for the shares, right? You all know that if you buy a call, you have the right, not the obligation to buy the stock. So think about it. If somebody gave you the choice to say, hey, I'll let you buy my shares, you can either pay 100 or you can pay 105, what would you say? Well, obviously, when it comes to buying shares, lower prices are better. And as I've talked about before, that in the financial markets, if there is a benefit, that is an automatic way to realize it is going to cost you more. So if it's a benefit to pay 100 instead of 105, that's another way to figure out the $100 call has to be worth more money. What about for the puts? Let's say we're looking at the July 100 put and the July 105. What does our pricing principle up here say? It says that higher strike puts have to be worth more money. So again, without looking at a pricing model, nothing else. I can tell you right now for sure the July 105 put will have a higher price tag on its head. And one way we can kind of back into this logically is to say that a put option gives you the right to sell shares. And would you rather receive $100 for your shares or 105? Well, when it comes to selling options or selling anything for that matter, higher prices are better. So if the 105 put gives you the right to receive more money, that's a benefit, and you should be able to say, therefore, it must trade for a higher value. So that's really the essence of our first pricing boundary. Now, there's an interesting word here, though, as I mentioned earlier, is the word must. I didn't say that it should be or that in most cases it must. And that's a pretty powerful word. Usually in the financial markets, people go, oh, well, this is what it should be, but anything goes. There's always exceptions. Not here. There are no exceptions. So why is that? Well, the reason is we have this process called arbitrage. A lot of people have heard the word arbitrage, but don't really understand what it means. A fairly simple definition is that it's a series of trades that result in a guaranteed profit. It's from pricing discrepancies. However, this is a definition that a lot of people say, and it's really incomplete. It's a second part to the definition that there must be no cash outlay on your part. It has to be what we call self-financing. Now, why is that? Well, if we didn't have the second condition in here, you could go buy a bank CD and say, hey, I arbitraged out a trade because I got a guaranteed profit. Or I bought a T-bill. Well, those aren't arbitrages. That's just a risk-free investment. This is a little bit deeper than a risk-free investment. It's because of pricing discrepancies in the market that set up basically free money. It's like finding free money on the ground. You don't have to do anything for it. It's just because of these pricing discrepancies. Now, before we continue, a lot of times you'll hear people say, arbitrage just should be illegal. These guys are the vultures of the trading world. And for some reason, a lot of times they're met with this negative connotation, this whole image of arbitrage. Now, in today's world, it's not done by humans, at least not much. There used to be back in the day what are called arb desks, arb being short for arbitrage. Now it's all done by computers, which is why you're not going to find any arbitrage opportunities. It is all done within microseconds, if there is even a hint of it coming into play. But the thing is right now is that this is really a bad viewpoint of arbitrage. Arbitrage is what keeps prices in line. It's what keeps prices fair for the rest of us. And that's how we know that these pricing principles must absolutely hold. All right, there are no exceptions. So one way to show it, let's pretend that there is an exception. Let's say that we see the $100 call trading for 5 and the 105 call trading for 6. Now, I did this just to make the numbers easy. I could have made it 5.01, and we would still end up with the same idea. So what did the pricing principle say here for calls? It says that the $100 call must be worth more money. Now, we're also assuming, I didn't print them in here, but they're the same expiration just to make it a little easier to see. So we know it should be worth more money, but it's trading for $5. What's an arbitrage or a computerized program going to do here? Well, one of the basic arbitrages, in most cases, is to buy the relatively undervalued one and simultaneously sell the overvalued one. So this also gets back to what we talked about last week with relative pricing. See, I don't know, both of these options could be outrageously priced according to a pricing model, and it doesn't matter. Relative to each other, I can tell you that there is a pricing discrepancy here. And again, this is so critical to become better options traders. So what's going to happen? Well, if we execute both of these trades, you're going to get a net credit of 1. Notice you're going to receive 6 from the sale. And what you're really doing is taking the $6 that you received and taking 5 of those dollars and buying the 100 call. So again, it's self-financing. You didn't need any of your own money. You simply sold an option, got $6 in your pocket, take 5 of those out, and you buy the 100 call. That's where this net credit of 1 is coming in. So what's going to happen if we did this? We buy the 100 call, we sell the 105 net credit of 1. This is our risk graph. Now look at that. How cool is this? There's our 0 line. And notice that the entire curve sits above 0. You can't lose. That's why it's an arbitrage. You're guaranteed to make at least $1, even if the stock goes to 0, but anything below 100 at expiration. That's our long strike. And we have a maximum of 6. And that's if both options go in the money, because we have the right to pay 100, obligation to sell for 105. That's another $5 on top of the dollar in our pocket. So not a bad deal, right? So again, don't expect these to happen in the markets. What's important is to understand why the arbitrage has to work and why this pricing principle must work. So what's going to happen? If this were to actually occur, well, traders are going to rush in, or computerized programs are going to trade in. They're going to put tremendous buying pressure on the 100 call, right? Because that's the one that they're buying. They're going to put tremendous selling pressure on the 105. What does that do? It's going to boost the $100 calls price. It's going to start trading for more than 5. And it's going to reduce the 105 calls price below 6. But as long as the 105 call is worth more than 5, it's free money. So who's going to stop? Right? It's like finding thousands of dollars on the ground and saying, you know what, just pick up a couple of those hundreds and then stop. Not going to happen. The market is going to attack this relentlessly until what happens? Until the $100 call becomes worth more than the 105. And at that point, the free ATM is turned off. That's the only thing that turns this off. The 100 call has to be worth more than the 105. So right back to our pricing principle. So what would happen is we would move from this risk graph that we saw in blue to something like this. We're going to see it shift below 0, which is why all risk graphs have to have a portion below 0 and a portion above. Otherwise, it's an arbitrage. See, now I can't really say if the $100 call is the better deal or the 105, because we've at least we've brought them back to within this pricing boundary. All right, so that's how we know for sure that the $100 call has to be worth more than the 105. What about the put options? Same idea in reverse. Let's say we've got the 100 put trading for 6, the 105 put trading for 5. Now, our pricing principle said higher strike put should be worth more money. What do we see here? Not so. 105 put is cheaper. So what's going to happen? People are going to sell the 100 put $6 in their pocket, take 5 of those out and buy the 105 put, and they get this nice credit of $1. Again, self-financing, they do not need their own cash. It's the pricing discrepancy that finances the arbitrage. So if you were to do this, if you were to sell the 100 put and buy the 105, net credit of 1, this is what you look like. It's a bear spread for a credit, right? Normally, for those of you who understand spreads, a bear spread, which should be a debit, you're in control of the more valuable strike, should be a debit. But somebody's paying you a credit. That's another way to understand that something is wrong. So here's our 0 line. There's our our minimum gain of $1, even if the stock rises above 105. But we have to make a maximum of 6. That's if the stock goes to 100 or below. So it's just a vertical spread, but it's a vertical spread that's too good to be true. And because of that, traders are going to relentlessly hammer the sale of the 100 put. They're going to relentlessly hammer the purchases of the 105. What happens? The spread between them starts to narrow. And until the 105 put price becomes greater than the 100 calls, and at that point, the arbitrage is turned off. No more free ATM. And again, this is how we know the 105 put absolutely must be worth more than the 100. And then we're going to see this. We were on the blue curve, and we're just going to shift below 0, some portion of it. Of course, this comes into where the stock is, the volatility, the risk reward, but some portion of that risk graph has to be below 0. And now it's hard to say, relatively speaking, which one is maybe advantageously priced. We'd have to dig a little deeper. But right now we have very good ideas if we see that this basic pricing relationship is ever violated. All right, let's see if it actually holds in the real world. Here are some Microsoft quotes. I just shot them from this afternoon. And try it for yourself. Doesn't matter which expiration. These weren't cherry-picked. But here's our strikes down in the center. Notice that we have the lower strikes at the top. That's a 235, 240, and so on down to 290 at the bottom. All right, so low strikes on top, higher strikes on the bottom. Let's start with the calls. I'm going to use the mark, which I think most of you know is the halfway point between the bid and the ask. It's just kind of a good proxy for the price of the option. And what do you notice? Look at this on the top, $44, most expensive option on the board. We drop down a row, what happens? A little bit cheaper, almost 41. Drop down a row, a little cheaper, little cheaper, 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 25, 22, 20, 18. I mean, look at this, all the way down. They are getting progressively cheaper. Why? Because of this pricing principle. This absolutely must happen. What about over on the puts? Puts, we should see the reverse. Higher strike puts should be worth more money. So let's start at the bottom. We see 36 and change, 33, 30, 27, and progressively cheaper all the way up to about 12 bucks. Why is that? It is not a coincidence. It is because of arbitrage. And it is because of this arbitrage and this pricing principle, you know for an absolute fact that these pricing relationships must occur. And if you know that, you're in a lot more possession of a lot better information than the average trader. People just look at these quote boards and they get overwhelmed. There are very logical progressions, mathematical connections, and this is one of the most important. All right, so does everybody see that? So try it for yourself, continue to practice with it. Now let's go back to our questions, and based on what we've learned here, see if we can make sense of this. Look at the first one. You're going to buy the March 85 and sell Jan 70. Another little hint, it doesn't matter which expiration you have. That's an interest rate thing. It's a timing thing. What's happening? You're buying the 85 call and selling the Jan 70. Forget about the expirations. Which is the lower strike call? That's the only thing I need to see. Then I need to say what's driving it. It's a sale. It's a short call. If you're short a call, it's bearish. You've got negative deltas. This is just a hedge over here. And there's your risk graph. Has a very bearish bias. Let's take a look at the second one. We're going to buy the 200 put for July, sell the July 210. Again, don't even worry about your expirations. You're buying the 210 put. You're buying the 200, you're selling the 210. Which is the more valuable put? Higher strikes. That's the only thing I need to see with my eye. I look at the 210 put, then I say, what are we doing with it? We're selling it. That's what's driving this strategy. Why? Because it's the most valuable option. And that is such a key part to understanding your strategies and your hedges, rolls, and morphs. All right, so once I see that this is the more valuable one and we're selling it, I know it has positive deltas. All right, you're selling a put. This is just a hedge. And there we go. Instantly, I could see that that has a bullish bias. Now, what about this one? We're going to buy the Jan 100 call and buy the Jan 105 put for 9. Most of you recognize that as a strategy called a strangle, similar to a straddle, call and a put, same expiration. But what do you notice it's different here? Most of the time, if you're doing a straddle or for a strangle, because we have different strikes, we put the lower strike put on the bottom and the higher strike call on top. And there's a reason why we typically do that. But what have I done here? I've switched them. This is what's called a guts version. And there are times that we use this. But take a look. I've got the 100 call, which is a lower strike than 105. So it's got more value if this were a call. But this is the 105 put. And it has more value among the puts if this were a 100 put. And you've heard us talk about calls or puts or calls. So in a way, I can compare this. I can see that I have the right to buy at 100, and I've also got the right to sell at 105. Now think about that. If I absolutely have the right to pay 100 and I have the right to sell at 105, that is a guaranteed $5 in my pocket. This is what's called a box position. And one of the reasons we will use this is to mitigate theta. But we should look at this and say, okay, yes, we paid 9, and most of you probably answered that your max loss is 9. That's what you're usually taught. This is why professional traders will see this in a different way. Yes, you paid 9, but we're getting $5 back from this box. So if you put this on, there you go. There's your maximum loss. You see that bottom line's up at -4, not at -9. And if you didn't see that, you're going to make mistakes with your decisions. So these are just a very small handful of the benefits you can see from one pricing principle. There's lots of them out there, and we're going to be talking about them in the future. But what I want you to do is to just work with them, work with this one. And on Thursday, we're going to look at number 2, and then we'll put them together into some more interesting ways for Friday and the following week. So again, if these were new to you, if you didn't get the questions, if you're not seeing the quote board in this way, this is where a coach will be worth his weight in gold. That's all I can tell you. Another benefit, risk-free. You don't hear that too often in the markets. I've often said that knowledge is a risk-free investment. Take it when you have it. Give them a call. Just see what they can help you with. Let them know what kind of trading you're doing, what kind of strategies, and just have a chat with them. It cannot hurt. So if you're interested in that, the number is 815-957-9125. Please give them a call. And I hope you learned something today. And we'll see you on Thursday for pricing principle number 2.